Introduction. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution. Signals only. Past performance is not indicative of future results. This episode is brought to you by Iron Condor Command, the definitive guide that has helped thousands of traders master defined risk strategies with confidence. The week ahead stands defined by one central tension. Markets closed the prior session near all-time highs, yet the volatility index refused to confirm any sense of panic or euphoria. It simply sat in that contemplative high-teen zone we have come to recognize as fertile ground for disciplined premium sellers. You and I both know what that setup really means. Headlines will scream about central bank decisions, earnings from the largest technology names, and fresh readings on inflation and housing. The tape, however, has already shown us something different. It showed us contained daily ranges, suppressed realized movement, and a volatility index that continues to price in more fear than it ultimately delivers. That gap between implied and realized is exactly where the edge lives for those of us who trade with defined risk, patience, and process. And if you are new to these Sunday forecasts, welcome. This is the moment each week where we step back from the noise, review what the tape actually told us, and prepare our Iron Condor framework for the sessions ahead. We do not chase narratives here. We follow the math, the structure, and the risk management that has protected capital through tariff escalations, Middle East flare-ups, and every other geopolitical headline the media tried to sell as the next crisis. The setup. Let us begin by anchoring ourselves in where we finished the week just ended. The S&P 500 closed Friday at 7,165. That marked a modest gain on the week of roughly 0.75%. The index ground higher in that mechanical fashion we have seen repeatedly this year. Nothing dramatic. Nothing that required heroic conviction from buyers. Just steady accumulation inside remarkably narrow daily ranges. The VIX settled the week at 18.55. It spent the entire 5 sessions anchored between the high teens and low 20s, never once confirming the protective put-buying frenzy the financial press kept highlighting. You and I know what that refusal really signaled. It signaled that the market had already priced in the tariff deadlines, the renewed tensions over the Strait of Hormuz, and the latest round of sanctions chatter. When implied volatility refuses to expand while realized volatility stays crushed below 14%, the edge belongs to those willing to sell that overpriced premium inside defined risk structures. Gold traded mixed across the week closing Friday near $4,740 after drifting lower midweek then recovering. The dollar index firmed early in the week, reaching 98.8 before easing back to 98.51. Crude oil pushed steadily higher, closing the week near $94.40 as concerns over energy choke points in the Middle East kept buyers engaged. Bitcoin and Ethereum both held firm, with Bitcoin finishing near $78,400. None of these cross-asset moves were violent enough to break the S&P out of its recent range. That is the setup you need to keep in mind heading into Monday. A market that continues to respect its recent highs, while volatility remains stubbornly complacent. This environment favors exactly the type of theta positive strategies we run at VIXShield. Daily Zero, DTE Iron Condors on the S&P 500. Structures that do not care about the next headline, only about whether price stays inside the expected daily range. And that is the thread I want you to hold on to as we walk through the calendar ahead. The tape has been telling us for weeks now that this is not a breakout market. It is a range-bound, mean-reverting market that rewards patience, and punishes those who chase momentum or buy insurance at elevated implied levels. The twist now, let us turn our attention to the specific events that could test that range-bound character in the coming days. The economic calendar this week carries more weight than usual because it culminates with the Federal Reserve interest rate decision on Wednesday. Monday morning brings the Dallas Federal Reserve Manufacturing Index at 10:30 Eastern. By itself, this regional gauge rarely moves markets, but in a week already focused on policy, it will be watched for any hint of softening or resilience in the industrial sector. Tuesday features the ADP employment change at 8:15 Eastern, followed by the S&P case, Schiller home price data at 9 Eastern, and consumer confidence at 10 Eastern. These readings matter because housing and labor remain two of the stickiest parts of the post-pandemic economy. If consumer confidence continues to slide, while home prices hold firm, that divergence will feed directly into how traders position ahead of the Fed. Wednesday is the busiest day. We get building permits, durable goods orders, housing starts, and the goods trade balance all landing before the market open. Then at 2 Eastern, the Federal Reserve announces its rate decision. Consensus sits at 3.75%, with no change widely expected. What matters far more is the tone in the statement, and especially the press conference that follows at 2:30. You and I have seen this movie before. The Fed can sound measured and data-dependent, yet the bond market and the volatility index can hear something entirely different. If the press conference leans even slightly more hawkish than expected, we could see the dollar firm further and gold come under pressure once again. That cross-asset reaction would be the real signal for our iron Condor positioning. Thursday brings weekly jobless claims and the advance reading on first quarter GDP. The GDP print in particular will be scrutinized for any signs that the tariff and policy uncertainty we discussed on Saturday is beginning to weigh on growth. Finally, Friday delivers the core personal consumption expenditures price index. That is the Federal Reserve's preferred inflation gauge. A soft reading would likely reinforce the idea that the Fed can remain on hold without urgency. A hotter than expected print would raise questions about whether 3.75% is truly restrictive enough. Layer on top of this calendar the beginning of Magnificent Seven earnings. Several of the largest technology names report this week. While we do not trade individual equities, the implied volatility embedded in index options will rise and fall with expectations around those reports. That rotation of volatility from single names into the index creates exactly the kind of setup where our expected daily range discipline becomes critical. And then, of course, the geopolitical backdrop refuses to stay quiet. Tariff deadlines remain on the calendar for August, yet fresh rhetoric continues to surface. Tensions around energy supply routes in the Middle East have already pushed crude above $94. Sanctions chatter involving Iran, China, and India adds another layer of uncertainty that markets have so far chosen to ignore. You and I know what that usually means. The longer the VIX stays anchored in the high teens, while these stories circulate, the more complacent traders become, until one day the realization phase arrives. Our job is to remain prepared without becoming reactive. The resolution against that calendar, we must now examine the current state of the VIX term structure and what it tells us about iron Condor entry conditions for the week ahead. As we sit here on Sunday, the VIX future curve remains in normal contango. The spread between near-term and longer-dated volatility sits at roughly 2.59 points. That is the calm, healthy state of markets we have discussed many times. Contango means longer-dated volatility is priced higher than near-term volatility. That structure naturally decays in our favor when we sell short-dated premium because time works for us rather than against us. At current VIX levels, around 18.7, The term premium embedded in that contango sits near 13 to 14%. That is meaningful. It tells us that the volatility risk premium remains elevated enough to harvest, yet not so extreme that we should expect violent mean reversion. In plain language, this is the environment where our daily 0 DTE iron condors have historically performed with consistency. The structure rewards sellers who respect the expected daily range and refuse to chase adjustments during peak gamma windows. If the Federal Reserve on Wednesday delivers a press conference that the bond market interprets as dovish, we could see the VIX drift lower toward the upper teens. That would widen the contango slightly and keep our edge intact. Conversely, if the tone is perceived as hawkish and the dollar pushes above 99, we might see the VIX test the low 20s. Even then, the term structure would likely remain in contango, just with a steeper near-term spike. That is still workable for defined risk sellers, provided we let the adaptive layered VIX hedge do its job. The key insight here is simple. The term structure is not signaling distress. It is signaling opportunity for those structured correctly. When implied volatility sits comfortably above realized volatility and the curve slopes upward in classic contango, the math favors the patient premium collector. That has been the story of the past several weeks, and there is no evidence yet that the week ahead will break that pattern. The bigger picture. Bigger picture. Let us now pull back and examine the broader geopolitical currents that will flow beneath these economic releases. First, the tariff situation. Fresh deadlines and renewed rhetoric around 25% levies on nations trading with Iran continue to circulate. Markets have front-run much of this already. The tape showed us that clearly last week when gold sold off, despite the headlines, and the dollar held firm. Yet if any concrete enforcement language emerges this week, the reaction in cross-asset markets could become more pronounced. That is why we watch the DXY in gold so carefully. They often tell us what the equity market is only pretending to ignore. Second, the Middle East theater. Crude oil climbed steadily through the week closing at $94.40. That move was driven by genuine concerns over supply disruptions through the Strait of Hormuz and ongoing Ukraine-related energy risks. Higher energy prices act as a tax on consumers and businesses. They tend to weigh on discretionary spending and eventually show up in consumer confidence and retail sales data. If crude pushes toward $100, we will need to monitor whether that begins to bleed into equity volatility. So far, it has not. The VIX refusal to confirm that pressure is itself a data point. Third, the central bank alignment. The Federal Reserve decision sits at the center of the week, but we also have echoes from the European Central Bank and Bank of Japan in the background. The daily Saba coverage this weekend captured it well. Central banks remain wary amid war, energy strains, and fragmented trade policy. When major institutions all lean toward caution simultaneously, the result is often lower realized volatility than the headlines would suggest. That is precisely the environment where our short premium approach has its highest probability of success. Fourth, the technology and antitrust undercurrent. With Magnificent Seven earnings arriving, the market will once again debate concentration risk, regulatory pressure, and artificial intelligence investment cycles. Sector rotation away from over-owned names into value or small caps often creates the kind of chop that keeps the S&P inside its expected daily range. That chop is our friend. It allows theta to do the heavy lifting while our defined risk wings stay untouched. Fifth, and finally, the immigration, labor, and housing policy dynamics that quietly shape the data we will see released this week. Building permits, housing starts, and consumer confidence all reflect decisions made months ago in Washington and at the state level. When policy creates friction in the housing market, or labor force participation, the numbers that eventually print can surprise in either direction. Our conservative lens reminds us not to trust the initial headline reaction, but to watch how the bond market and volatility index digest the information. That is where the real capital flow signal lives. Each of these five threads: tariffs, energy geopolitics, central bank caution, technology concentration, and domestic policy effects on housing and labor, has the potential to move markets. Yet none of them has so far been enough to break the VIX out of its high teens anchor. That stubborn complacency is the real story. It is what separates the narrative from the tape, and it is exactly why we continue to favor defined risk-income strategies over directional, long volatility bets. The scorecard. With the calendar and the bigger picture in mind, let us now review how our VIXShield strategy is positioned heading into this week. Friday's rapid skew artificial intelligence signal kept us in conservative mode. We placed the conservative tier Iron Condor with strikes designed to capture premium while remaining outside the expected daily range. Although specific strike levels for this coming week are not available in advance, the framework remains unchanged. We target wings roughly 3 delta on the put side and 5 delta on the call side when the VIX sits in the 15 to 20 zone. That positioning has delivered an 88% recovery rate on temporary breaches when combined with our temporal theta martingale and adaptive layered VIX hedge. For these structures to succeed this week, the S&P 500 needs to continue respecting its recent range. If the index can close the week between roughly 7,000 and 7,300, we remain firmly inside the probability envelope that has rewarded us repeatedly. That is not a prediction. It is simply the mathematical expression of the expected move derived from current implied volatility and the term structure. Our expected daily range discipline will be especially important on Wednesday and Friday. High-impact events like the Fed decision and the core PCE print tend to compress or expand that range in real time. When the EDR tightens, we tighten our position size. When the EDR expands, we maintain strict 10% of capital maximum risk per campaign. This is not discretionary, it is rule-based. And those rules exist because we have studied the back-tested record from 2015 through 2025. The data shows clearly that respecting the EDR and refusing to adjust during peak gamma windows between 1:30 and 2 Eastern is what turns an ordinary strategy into a repeatable edge. The adaptive layered VIX hedge remains fully engaged in its standard 4-4-2 configuration. Short 30-day VIX futures, medium 110-day, and long 220-day in that ratio. This layered approach has historically cut portfolio drawdowns by 35 to 40% at an annual cost of roughly 1 to 2%. In an elevated but non-panic VIX regime like the one we currently inhabit, that hedge acts as portfolio insurance that actually pays for itself through the theta collected on the iron condors. VIX trend rules remain on the side of patience. We do not chase aggressive tiers when the index sits near 18.7. We stay conservative, we let the signals dictate entry, and we allow theta to compound without interference. That discipline is what separates those who survive multiple market cycles from those who do not. Preview. So here is exactly what I will be watching when the market opens Monday morning. First, the overnight reaction in Asian and European sessions to any fresh tariff commentary. Second, the dollar index behavior around 98.5. If it holds above that level, it reinforces the idea that real rates remain supportive of contained equity volatility. Third, any early movement in crude above $95. That would signal whether energy supply concerns are beginning to price into broader risk assets. Monday's Dallas Fed number and Tuesday's confidence and housing data will set the tone ahead of Wednesday's main event. If those prints come in line with expectations, the Fed decision may land with limited fanfare. If any of them surprise to the downside, the press conference will carry extra weight. For our Iron Condor book, the most important levels remain the expected daily range boundaries derived from Friday's settlement. Stay inside those levels, and theta does the work. Breach them temporarily, and the adaptive layered VIX hedge, plus our martingale recovery rules, are designed to bring the equity curve back to positive. This week is a perfect illustration of why we built VIXShield the way we did. Not to predict the news, but to remain neutral to it. The geopolitical risks have not disappeared. The policy uncertainty has not vanished. Yet the volatility index continues to tell us those risks are already reflected in current pricing. When the tape and the headlines diverge this sharply, the disciplined trader trusts the tape. If you are paper trading the unlimited cash system for the first time, this is an ideal environment to observe. Watch how the conservative tier collects credit day after day, while the hedge remains largely dormant. Notice how the absence of stop losses and the presence of strict position sizing removes emotion from the process. That is the edge. Not a single brilliant call, but a repeatable process that compounds through uncertainty. Closing. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution. Signals only. Past performance is not indicative of future results. If you found this summary valuable, consider upgrading to Pro or higher for the full twice-daily VIXShield market summaries, proprietary signals, and private RSS feed. Visit VIXShield.com to learn more. And now you know what the tape was really saying this week. This is VIXShield, your protection against market uncertainty.